Hi friends, very good morning all of you. Welcome back to CAP classes. As I promised you that I'll give you a super quick revision of all the accounting standards. In the series, this is going to be the first video and we are starting with Accounting Standard 1. If you want detailed lectures, all of them are already available in my YouTube channel, you can see, and this is going to be a T20 match. Okay, so within 5 to 10 minutes, how can we revise the standard and how can we solve the problems? The more focus of these videos will be on solving problems, okay, not on the principles of the standard, because anyway they are available in my YouTube channel CAP classes. Okay, so now let us see what is Accounting Standard 1. Disclosure of accounting policies. So basically there are three fundamental accounting assumptions. They are going concern, consistency, accrual. Going concern, consistency, accrual. Remember simple logic. If they are followed, no need to disclose anything. If they are not followed, you need to disclose in notes to accounts that the fundamental accounting assumptions are not followed. That means the company is following fundamental accounting assumptions itself is an assumption. So I assume that the company is following all the three fundamental accounting assumptions. If you are not following it, tell me. If you are following it, no need to tell anything. Then accounting policies are, the basic accounting principles and the methods of following that principles. Okay. So now they have given one more chart for that. So all the significant accounting policies are to be disclosed. All the significant accounting policies are to be disclosed. Accounting policy can be changed if it results in better presentation of financial statements, if it is required by law, and if it is required by another accounting standard. If you are changing accounting policy, that might have impact on the current year financial statements, or that may affect your future period financial statements also. So whenever a change in the accounting policy is affecting P&L, that means the profit or loss for the year, or the net assets, that means assets or liabilities, that fact should be disclosed. Point number one. If you can quantify the impact, I have changed, from policy A to policy B. Because of that, there is an impact of 4 crores to the P&L. That means current year P&L is, has decreased by 4 crores. That if you can quantify, show it. If you cannot quantify, disclose in notes to accounts that we changed the accounting policy from policy 1 to policy 2, and the impact, the magnitude, the effect of the change in accounting policy on the financial statements, on the financial performance and position cannot be measured. That you need to disclose, but it rarely happens. 99.9% of cases, management will be in a position to quantify the effect of change in accounting policy, so you disclose that also. And on the right hand side, if you see, if a non-material in current period but ascertainable in later periods, current period you don't know, later periods it will have an impact, then the fact of such change in the later period also should be disclosed in the current period itself. In the current period itself, you have to disclose that in later period there will be one change. So now look at the problems. They have given 4 or 5 problems. Problem number 1. In the books of Messrs Prashant Limited, listen, this is given in RTPs, this is given in model paper, this is given in your study material, this was there in old syllabus, this was there in CA final also. Okay, so in the books of Messrs Prashant Limited, closing inventory as on 31st March 2015 amounts to 1,63,000 on the basis of FIFO, first in first out. The company decides to change from FIFO to weighted average method for ascertaining the cost of inventory from the year 14-15. On the basis of weighted average method, closing inventory as on 31st March amounts to 1,47,000. Realizable value of inventory as on 31st March amounts to 1,95,000. So simple, step 1. According to accounting standard 2, inventory should be valued at cost or NRV, whichever is lower. Point number 2. Cost can be determined by following any method. It can be FIFO, it can be weighted average method, and there are few other methods also like retail method, standard cost method, etc. So the company is following FIFO till this year. From next year onwards, they are following, from the current balance sheet onwards, they are following weighted average method, because of which there is a decrease in the profit. What is the difference? From 1,47,000 to 1,63,000, there is a difference of 16,000. So simple. From FIFO to weighted average method, when you are changing the accounting policy, it amounts to a change in the accounting policy as per accounting standard 1. Point number 2. The company should disclose in notes to accounts that they changed the accounting policy due to which there is an impact of 16,000 rupees on the P&L. The Inventory and the profit for the year comes down by 16,000 rupees. This is what you need to mention. That's all. This is question number 1. Question number 2. ABC Limited was making provision for non-moving inventory based on issues for the last 12 months up to 31/3/2016. So what is this? Non-moving inventory. That means you have inventory. In the inventory, there are certain items which are very slow moving. That means the turnover is very less. So you are not consuming it more, you are not selling it more. So slow moving inventories, non-moving inventories. So what you used to do previously, you used to make a provision for 12 months. That means if any inventory is not consumed for 12 months, then you are creating a provision. But this year what you have done, you changed it to technical evaluation. The company wants to provide during the year ending 31st March 2017 based on technical evaluation. That means you are calling one expert. That expert is verifying the inventory and saying this inventory will be obsolete, this will be obsolete. So create a provision. So previously what was the model? You used to follow 12 months, provision for 12 months. Provision for goods which are not used for 12 months. Now you are doing technical evaluation. So total value of inventory 100 lakhs. Provision required based on 12 months issue 3.5. Provision required based on technical evaluation 2.5. Does this amount to change in accounting policy? Can the company change the method of provision? So a provision is basically an accounting estimate. A provision is basically an accounting estimate. So in this question what you are doing, from one way of calculating provision to another way of calculating provision, you are migrating. What is the impact? 3.5 lakhs of provision is becoming 2.5 lakhs. That means your profit will increase by 1 lakh. Your profit for the current period will increase by 1 lakh. So how the answer is to be given? They have given. The decision of making provision for non-moving inventory on the basis of technical evaluation does not amount to change in accounting policy. Why? That is accounting estimate. So you are changing one method of estimation to another method of estimation. That is not change in accounting policy. And another thing is, if you look at the impact, what is the difference? 3.5 to 2.5, it is only 1 lakh. So out of 100 lakh rupees of inventory, 1 lakh may not even be material. If the management believes that 1 lakh rupees of difference in inventory valuation is material, you disclose it in notes to accounts. Otherwise, that is also not required. That's it. This question is over. 3. Jagannath Limited has made a rights issue. See, this question is also there in CA final old syllabus. I have my own concerns about this question. Initially, when you read the question, it looks like, oh my god, the company is doing some window dressing. The company is intentionally changing the profit figures. But the way how ICI has given the answer, just something happened in the question, you are giving notes to accounts. That's all. Okay. So in the offer document, it projected a surplus of 40 crores during the accounting year to end on 31st March 2017. The draft results for the year prepared hitherto followed accounting policies and presented for perusal of board of directors showed a deficit of 10 crores. So in the projections, when you are issuing rights shares, in the projections you said you will get 40 crores of profit. Now when the draft financial statements are prepared, you have a loss of 10 crores. That is the reason you are changing accounting policies, which as a prudent accountant, I do not like it. But still the question is given like that, so we'll travel with the question. But the first para, no, I am quite uncomfortable with this, because simply because you have given projection of 40 crores, you will not match your current year profit to 40 crores. No, that is fraud. Okay, but the company is saying they changed something, so how that notes to accounts will be written? Value of year end inventory at works cost 50 crores. What is works cost? Works cost, do you remember? Direct material, direct labor, direct expenses, put together prime cost. Add factory overheads will become works cost. So now year-end inventory is 50 crores at present based on works cost. Instead of hitherto, method of valuation of inventory at prime cost. That means previously you are following prime cost. Now you are following factory cost. Why? Is it to match that 40 crores of profit? Don't ask me. But if this is the question, how to write the answer, I tell you. At present, the company is valuing inventory at prime cost, which is 30 crores. From the current period, the company is changing their valuation of inventory to factory overheads, which is 50 crores. Because of this, inventory will increase by 20 crores and the current year profit will increase by 20 crores. This is what you need to write. And then they have written so much of drama, like, capital intensive methods are implemented in the company, so we are doing automation, so more machines are there, so factory overheads are relevant. All that drama I did not like, very honestly. To be very honest, I did not like. But chalo, how the answer should be written? Step 1, at present the company is following prime cost, inventory value 30 crores. Step 2, now onwards the company is changing its valuation policy to factory overheads, which is 50 crores. Because of this change, profit increased by 20 crores and inventory is increased by 20 crores. Year end inventory, closing stock will increase by 20 crores. Khatam. 2. Provide depreciation for the year on straight line basis on account of substantial additions in the gross block during the year instead of reducing balance method, which was hitherto adopted. As a consequence, charge for depreciation at 27 crores is lower than the amount of 48 crores which would have been provided had the old method been followed by 18 crores. That means previously you are following one method of depreciation where your depreciation amount is 45 crores. Now you are changing it to straight line method where the depreciation will be 27 crores. So there is a decrease in depreciation by 18 crores. So profit will increase. Same notes you will write. Step 1. At present the company is following WDV method and the amount of depreciation is 45 crores. Now the method is changed to straight line method and the depreciation is 27 crores. Because of change in this accounting policy, the amount of profit increased by 18 crores because of decrease in depreciation. Again, I am telling you, I am not feeling good these points and all simply because they have given some projection, they are doing something, I did not like it. If I am the auditor, I would have resigned or I would have given, a qualified opinion. Then 3, not to provide for after sales expenses during the warranty period. Till the last year, provision at 2% of sales used to be made under the concept of matching of costs against revenue and actual expenses used to be charged against the provision. The board now decided to account for expenses as and when they are incurred. Sales during the year is 600 crores. Another major thing the board of directors are doing. Again, I am telling you, if I am the auditor, I am not convinced with this point, but because ICA has given the question and answer, I am explaining you. Previously, the company is charging, a provision of 2% for warranty and repairs. Now they are not creating any provision. As and when they are, incurring repairs or warranty cost, they are charging it to P&L. So how the answer should be written? Step 1. Up to the previous year, the company created a provision for warranty expenses at 2%. From the current year onwards, a provision is not created, but repair cost is recorded on actual basis. Because of this, 600 crore sales into 2%, that is equal to 12 crores. Profit is increased because a provision is not created. That is what you need to write. 4. Provide for permanent fall in the value of investments which fall had taken place over past 5 years, the provision being 10 crores. This only point I liked in this problem. There are long-term investments, the value has fallen, and you are recognizing 10 crore rupees of loss. Very good. It is as per accounting standard 13. How to write? During the financial year, the company recognized a decrease in the value of long-term investments, 10 crore rupees. This is as per accounting standard 13. That's it. So this is third question. And then fourth question. This is very interesting question. Okay, read the question once. Very interesting question, very important for your exam. XYZ company is engaged in the business of financial services and is undergoing tight liquidity position since most of the assets of the company are blocked in various claims or petitions on the special court. XYZ has accepted intercorporate deposits, ICD, and it is making its best efforts to settle the dues. There were claims at varied rates of interest from lenders from the due date of ICD to the date of repayment, from the due date of deposits till the repayment. The company has provided interest as per the terms of the contract till due date, and a note for non-provision of interest on the due date to date of repayment was effected in the financial statements. On account of uncertainties existing regarding the determination of the amount and in absence of any specific legal obligation at present as per the terms of contract, the company considers that these claims are in the nature of claims against the company not yet acknowledged as debt, and the same has been disclosed by way of notes in the accounts instead of making a provision in P&L. State whether the treatment given by the company is correct or not. Absolutely incorrect. Close your eyes. Absolutely incorrect. They are not doing as per proper accounting. So what is this situation? Let me explain. Your company, took some loan. ICD is nothing but one of the sources of finance. So you took some loan. So when you took loan, you have to repay loan along with interest, isn't it? So because of your financial position is poor, so you are unable to repay the loans. Now what happened? Look here. Okay, so this is where you borrowed money. This is where you are supposed to repay. That means actual repayment. But you reached up to this, but you are not in a position to pay. You are not in a position to pay. That is the reason this is in court. So what the company did, the company created a provision for this period, interest outstanding. But this period also your creditors are saying you need to pay interest for us because you have not yet paid loan. Say for example, loan is to be paid on one day, but you have not paid, no. Now what the company is saying, company is saying interest for this period I will create a provision because I have to pay. Interest for this period I have no legal obligation to pay. So I will disclose this as a contingent liability. Accounting standard 1 says, beta, what is the meaning of accrual? You have to create a provision for outstanding interest, or you create, outstanding interest journal entry itself. No need to create a provision, write outstanding interest journal entry. So in the question they said, from the date of, end of the life of debenture or deposit, subsequently, I don't need to pay any interest. I do not have any legal obligation, so I will not create a provision. What you need to say is the contention of the company is wrong because the company has not repaid the ICD on the due date. Subsequently also, the company has, a liability, an obligation to repay interest, to repay ICD along with interest. So a provision should be created. This is the answer. This particular question number 4 is little complicated. You need to read it carefully. Okay. That's it. AS1 is over. Keep watching. I will do all the accounting standards, and within 17 minutes we have completed, 17 and a half minutes we have completed the whole standard, principles and all the questions of ICI material. Like this, within 10 to 15 minutes or maybe within 20 minutes we'll do all the accounting standards. Keep watching CAP classes. Thank you.